Realty Income. Ticker O. More than 670 consecutive monthly dividend payments, going back to 1969. 12 payments a year. Not 4, not 2, not 1. Every single month for more than 5 decades. The Main Street test verdict on Realty Income today. Pass. 4 out of 4 rules. But one rule on this scorecard works differently for Realty Income than for anything else I've tested. The cover rule. Because this is a REIT, a real estate investment trust, and REITs don't pay their dividends out of earnings the way a normal company does. So the cover here is the tightest pass this channel has ever cleared. And it clears honestly. Here's the lineup. The streak, the cover, the yield band, the track record, the honest read, the receipt. Quick disclaimer first. This is not investment advice and it's not tax advice for your situation. Talk to a qualified accountant or financial advisor before you buy anything. The test I'm about to walk through is the one I use for my own portfolio. On the record, every position. What does Realty Income actually own? More than 15,500 commercial properties across all 50 states and several international markets. Convenience stores, dollar stores, drug stores, fitness centers, quick service restaurants, industrial logistics buildings, the kind of property you drive past every day without noticing the owner. Realty Income doesn't sell anything. They don't manufacture anything. They own the buildings. The tenants are names you'd know: 7-Eleven, Dollar General, F-Edex, Walgreens, Dollar Tree. They sign long-term leases, typically 10 to 15 years, on what's called a triple net structure. Triple net means the tenant pays the rent, and they also pay the property taxes, the building insurance, and the maintenance. Realty Income's job is to own the building and collect the check. That's a predictable, recession-resistant income stream, and it ties up almost no capital. The biggest tenant is under 5% of the rent, so no single bankruptcy can take the whole portfolio down. And then, the cadence. Realty Income pays monthly, every month since 1969. They've even trademarked the name the Monthly Dividend Company. The monthly check isn't a feature here, it's the whole brand. But here's the catch. This is a REIT. And a REIT doesn't play by the same rules. 3 differences, and they all matter for the test. 1. The 90% rule. By law, a REIT has to pay out at least 90% of its taxable income every year. So, when an industrial aristocrat pays out 60%, that's a board choice. When Realty Income pays 90+, that's the law. Which means part of what looks like discipline here is really just structure. 2. Earnings versus AFFO. Real estate carries huge depreciation charges. On paper, buildings lose value over 27.5 years, even as they actually rise in price. That drags reported earnings down, so a REIT's earnings look far smaller than the cash it really takes in. So measuring cover the usual way, earnings against dividends, gives you a garbage number for a REIT. The fix is a measure called AFFO, Adjusted Funds from Operations. Start with net income, add back that paper depreciation, strip out what they spend keeping the buildings up, and you land on the cash that's actually there to pay you. That's what Rule 2 runs on. Same 1.3 threshold, different number going in. 3. Where you hold it. REIT dividends are taxed as ordinary income, not the lower dividend rate most U.S. stocks get. Which is exactly why a REIT belongs in a Roth, where that tax disappears entirely. That's the structure. Now, the 4 rules. Rule 1, the streak. At least 10 straight years of dividend raises. Realty Income streak, as of 2026, 31 years. 3 times the channel's minimum and comfortably into dividend aristocrat territory. The pattern looks different from a normal quarterly payer, though. Realty Income raises in tiny steps, sometimes 1/10 of a cent a month, but it does it most quarters. The most recent monthly distribution stepped up from 27 cents flat to 27.1 cents in March 2026. That's a 0.4% raise. Small, but it's the 134th increase since the company went public in 1994. That drumbeat of tiny raises is the tell. The board treats the dividend as something always growing, not a once-a-year announcement the market has to guess at. Rule 1 verdict, pass 3 times over the line. Next rule. And this is where being a REIT actually changes the test. Rule 2. The cover. Same 1.3 threshold as every other stock, just measured on AFFO, not earnings. Look at Realty Income on an earnings basis and the payout looks impossible. Well over 200%. That's the depreciation illusion. Look at it on AFFO. The cash the business actually throws off. And the dividend is covered, but tight. The closest to the line any stock has come on this test. The needle sits in the green just near the threshold in the industrial names. A tight pass, but an honest one. 5 decades of unbroken monthly checks. No single tenant big enough to sink it. We'll come back to it in the honest read. Rule 2 verdict, pass. On the metric that actually counts for a REIT. That's the rule the REIT structure bends. The other 3 are more familiar. Let me run them. Quick one. If you're building a dividend portfolio from scratch in a Roth, this is the exact test I run on every stock I buy. Hit subscribe and you'll watch new tickers go through it and see how the 4 rules flex from one sector to the next. Back to Realty Income. Rule 3, the yield band, 2 to 7%. Realty Income's yield today lands in the upper half of that band. A high yield, but not a distressed one. Clear of the 2% floor, well under the 7% ceiling where the market starts pricing in distress. It's also sitting a little above its own 5-year average, and the price is just below its 52-week high. A modest discount, not a screaming one. But the entry timing is on the better end of the recent range. And paid monthly, that yield compounds 12 times a year, not once. Every payment buying a few more shares that pay the next one. The math's the same as an annual payer. The psychology isn't. Rule 3 verdict, pass. Inside the band, above its average. 1 rule left. Rule 4, the discipline test. No cut in 5 years and no freeze in 3. Realty Income over the last decade. 10 years of raises, 0 freezes, 0 cuts. We saw the shape back in Rule 1, small monthly steps adding up to 3 or 4% a year. What this rule really asks is simpler. Did the board hold the line through stress? Look at the record. Through COVID, the 2022 property downturn, the 2023 banking scare, the monthly distribution went up every quarter. No skipped raises, no frozen quarters. Rule 4 verdict, pass, 10 of 10. 4 rules clear. Framework, pass. Before the receipt, the honest read. 3 things to keep in the back of your mind. 1, the cover is tight. It clears on AFFO, but with a thinner cushion than the industrial names. A 10% drop in AFFO would put it below the line. That's the honest size of the margin. 2, interest rates. Realty Income borrows to buy buildings, so when rates rise, the margin on each new deal shrinks and AFFO growth slows. Exactly what the 2022 and 23 spike did. It's the biggest swing factor from here. 3, a slice of office exposure. Picked up in the 2024 Spirit Realty merger in a return-to-office market that's still uncertain. Small but real. Not a thesis breaker. So why am I buying it, not sitting it out? The cadence is the moat. The diversification backs it up. And in a Roth, that monthly income compounds faster than anything paid once a year. The framework's right, and that's why I own it. What would flip it? AFFO payout creeping above 85%. Or cover slipping below 1.18. A missed monthly distribution. That's an immediate retest. Or the yield past 7%, the market pricing in distress. Any one of those and we run the test again. Now, the receipt. The receipt. Start with the streak. 3 decades of raises, 3 times the minimum the test asks for. The cover clears on an AFFO basis, the tightest on the channel scorecard, but honest. The yield sits high in the band without tipping into distress. And the discipline is spotless. 10 clean years, no cut, no freeze. 4 rules, 4 passes. Realty Income passes the Main Street test. A monthly cadence that's held through rate cycles, recessions, and a global pandemic, and kept growing the whole way. What I'm doing, I added Realty Income to the Roth on June 1st as one of my opening positions. The first monthly dividend lands within a few weeks of buying. Barely more than a rounding error that first month. But that's the whole point. It shows up every month automatically, and each payment quietly buys a little more of the next one. Tiny in absolute terms, massive in concept. And so the snowball grows. That's the Main Street test on Realty Income. 4 rules: the verdict, the receipt. If you found this useful, hit subscribe and tell me what stock to run through the test next. Drop a ticker in the comments. The test is the receipt.